Hi, everyone, and welcome to this week's edition of What's Driving Token Prices. I'm your host, Katie Talati, Director of Research at Arca. For those joining us for the first time, I'm responsible for identifying and analyzing digital asset and blockchain opportunities for Arca's funds. As part of our research, my team and I examine token prices and the market events that act as catalysts for price change. Based on our research and market events over the past week, here are some notable token price movements and what we think drove these moves. As a reminder, this commentary is not intended to be investment advice, investment research, or an investment recommendation. Please consult your investment professional for your own circumstances. Well, everyone, welcome back to the show. It is officially the first week of August here. If you've been missing what's been going on in the news, the big thing in the last week is that Cold Card, a Bitcoin wallet, hard wallet provider, was compromised this past week, and that caused quite a stir among anybody holding funds in these wallets. Thankfully, they don't account. They aren't one of the larger hardware wallet providers, and so not necessarily as big as Ledger or Trezor. MicroStrategy reported selling 100 million worth of Bitcoin to continue funding their STRC dividends this past week, and Wells Fargo also announced that Wells Fargo announced their intention to offer tokenized deposits, kind of similar to what JP Morgan and Citi are doing. This would be via an internal private blockchain, but great to see that they are interested in adopting blockchain and crypto for these purposes. And finally, Clarity Act is still a work in progress on its way through Congress. It seems to be going back and forth quite a bit. But as always, we're here to talk about the tokens, so I will get right to it. So first up, I'm going to talk about Kamino. So Kamino, which is the largest lend and borrow protocol on Solana, they announced this week that they're actually wading into a new yield category that's going to generate returns through real world yield. So the product is called Kamino Institutional Yield, and it's going to begin by offering yield generated by commodity trade financing. And they're estimating that they can offer a target range of 7 to 8% annually. So I've talked about this before, kind of when crypto started, a lot of yield opportunities were generated through earning more crypto in the sense or earning yield on chain. So more and more in digital assets, a lot of products, especially in DeFi, are really searching for ways to offer yield that is kind of outside crypto, that isn't tied to crypto prices or to the price of Bitcoin. And more and more, it's been coming back to kind of more traditional credit opportunities. So this one's pretty cool just to see this, that is being brought on chain. And that's why we kind of call it real world yield instead of on-chain yield. So Kamino, though, they have been the leader in Solana-based RWA products. RWA specifically actually represent over 70% of their current 347 million loans outstanding right now. This past week, compounding that, Kamino also launched Auto, which is an RWA backed by near prime US auto loans, further cementing itself as the RWA venue on Solana for right now. The Kamino token is up just 30 basis points this week. Okay, next I'm going to talk about Solana. There actually were two big governance proposals this week for Solana, which is a large layer one, if you're not familiar, which is really tackling the inflation and burn issue on the SOL token. So the first proposal, called SIMD 0553, is introducing what are called resource-based fees. And basically the idea is that they want to charge on-chain transactions based on the resources they use, not just as like a flat fee. And so if you're doing a very complex transaction, you should have to pay more versus if you're just doing like a really simple, like send and receive transaction. So according to data, this should increase the daily SOL burns from 650 SOL to about 7,500 to 9,000 SOL. So over a 10x increase in those potential daily burns. A separate proposal called SIMD 0550 would decrease Solana's inflation, proposes to decrease Solana's inflation rate at basically a faster rate. So currently the way Solana inflation works is that it started at about, I think, 8% annually. And then every few years, that amount is decreased by 15%. This proposal would basically double that disinflation rate from 15% to 30%. And the idea would be that by 2029, you would get Solana annual inflation down to 1.5%, which would be great. In the last year, Solana, it's really underperformed if you haven't been following the crypto markets as closely, and their inflation rate has been blamed for some of that underperformance. The proposals to address this economic viability so previously there were some proposals to address Sol's economic viability in the market, but none of those have really gone through just yet. So these two new proposals of 0550 and 0553 are currently up for a vote among the validators. The voting ends on August 18th. Currently, though, only about 5.8% of the 15% quorum has voted on the proposal. So it's going to take a few more big validators to throw their hats in the ring on that. This is definitely, like I said, big for Solana's economic future. It is up 80 basis points this week. All right. Last up, I actually have something different here. So not tokens, but kind of close to it. And obviously two of them. So Coinbase and Circle have had quite volatile week of trading following their Q2 earnings reports and a partnership renewal. So last Thursday, Coinbase reported their Q2 earnings. They unfortunately missed on estimates for their revenue and EPS. Coinbase did trade down in the aftermarket hours as a result of this and is still down for the week. But Circle reported this morning actually with mixed results, missing on revenue, but beating their EPS estimates. Importantly, the supply of USDC, their stablecoin, also grew about 19% year over year. Circle did also announce that they're going to be launching their upcoming Layer 1 Arc on September 16th, along with announcing this list of initial validator partners, which include like Visa, MasterCard, BlackRock, Standard Chartered, kind of the usual suspects that you would expect. But what really took the market by surprise is actually the news that there was a renewal of the agreement of an agreement between Coinbase and Circle, by which Coinbase basically shares revenue with Circle for the USDC to stablecoin. So the agreement actually dates back to September of 2018, so a long time ago, and was restructured again in August 2023. It was set to automatically renew this month in August. So Coinbase's actually CFO confirmed that the agreement is going to be renewed, or it has been renewed, and that Coinbase is going to continue to earn 100% of income from USDC deposits on the Coinbase exchange. So the agreement, like I said, is pretty important for Coinbase because it drives a lot of their recurring revenue, but it does so at the cost of Circle's bottom line. So the stablecoin, just to give you an idea, stablecoin revenue at Coinbase is about 292 million of their 1.2 billion for Q2, which is a meaningful chunk also of just their subscription service revenue, not related to trading. So again, this agreement was great for Coinbase, not necessarily great for Circle because they're giving up a chunk of revenue. But one could argue that Coinbase has this distribution that allows Circle to continue having a large market cap for USDC. Not a surprise, Circle is up 3.8% for the week and Coinbase is down 5.5%. All right, guys, that's all I have for you this week. Tune in next week at 1 p.m. Pacific to hear what's driving token prices.